Hmm. So now it's on a return on capital employed. I've already mentioned this measures the level of returns a business has made using the capital it has within it. So you can actually check and say, okay, these returns have made a 10%. What is the target? What's the industry norm? If it is, instead of this capital that we have put into this business, suppose we had put it in treasury bills, what would it be? And you start comparing the numbers. And that's the beauty about financial analysis. So then we go to asset turnover. Here, oh yeah, actually, it's almost the same concept with ROS, but ROS is because then it goes to compare your returns based on your operating profit. This one is just looking at revenue. How much are you generating from the capital that we have employed? How much are you generating revenues? So if it's from a 1 quarter capital that has been employed, how much revenue are you generating? For example, if this ratio starts going down, it means that your capital that you're employing is not the right capital at all. It is a lazy capital. And you have the non-current asset turnover. It's almost the same concept. You have the fixed asset turnover, which is basically this non-current asset turnover. The other one, you can use capital employed or you can use total assets. It's the same thing. Here, there could be a number of things that would actually happen because when you're looking at and when you're analyzing financial data, there's first a formula that is there. That formula, look at it, what variable is the denominator, what variable is the numerator. If it is to increase, if you're looking at this, the numerator must reduce to give you a good number, or here on the non-current assets, you expect non-current assets to reduce to give you a good number, or you expect revenue to increase to give you a good number. So what are those variables that would actually help in increasing revenue? Maybe you've brought in a new product that has less competition, that is just driving the market to madness. It could be a COVID, a vaccination with less costs and you're generating more money. On the non-current assets, again, if it's bad, you expect the non-current assets will increase. So look at all these things. It could be just an issue of revaluation. You have revalued your assets upwards. If it's better, you have revalued the assets downwards. Or almost towards the end of the accounting year, you dispose the sum of the assets so that you improve the number. So that's what this ratio is. Liquidity. Like the mantra, like what everyone says, we always parrot this thing that cash is king. Liquidity is basically looking at your cash needs now. Do you have the liquidity enough to pay obligation as and when they fall due? So what's the level of your current assets against your current liabilities? This is where now you have to do your current ratio. If your current assets are higher but not enough, maybe greater than 1, when maybe supposed to be 1.5, based on the industry where you are, against the current liabilities. But also, when you're analyzing these things, Yvonne and the team, Look at the composition of your current assets. You would find that in the previous year, your cash was much, much lower than what you have in the current year, but yet your current ratio is very low. Look at that. So as much as in theory we're saying your current ratio must be higher than in the previous ratio, in the previous year, but that year where you had so much cash, it could even be a better year than the previous year, where you have made more cash and liabilities and less inventory or something like that. So look at the composition of the current assets, the elements that are in there, and come up with an intelligent response or analysis. Obviously, we know that working capital equals current assets less current liabilities, because the elements of working capital are known. You have inventory, you have receivables, you have payables. It's just basically the theory. I've already explained what it is. The current ratio. I have explained it, but you need to check what are what are the elements within current assets and how are they, what's the proportion within against the year which you are comparing with. However, some companies function adequately on current ratios of less than 1, whilst others need a much higher ratio. So you need to understand that what is the industry standard. Don't just say, no, it's less than 1, it's not doing fine. No. You don't need to do that. That's why I said you investigate the elements within the current assets. Then we have the asset test. Obviously, some factors that you would consider is the asset quality, seasonality. That is very important to look at. Here, what you have done is that you have said, no, yes, this current asset, current ratio is okay, but there is a component that cannot be easily converted into cash. That is inventory. So let's remove it so that we have the quick ratio or the asset test ratio. So this shows how easily a company can meet its current obligations using funds raised from quick assets. Those are assets which can be easily converted into cash. So a comparison of the quick ratio and current ratios, which shows increase in both, but with the current ratio increasing more, would indicate that the company has been building up stock. Because then now you are seeing the missing link is the inventory. So if you see that, then it could be the possibility that the company is increasing on inventory. So when you do also your inventory days, you, even when it is increasing, do not just stop there. The analysis may not be complete. You also look at your inventory against your cost of sales and find those days. You find that, yes, the inventory has increased, but the inventory days has gone down, then there's no harm. So try to combine these with the working capital days, with your quick ratio. In the corporate world, when you're analyzing this, you don't analyze them line by line, you integrate them. Because then you get a full picture. One ratio in a particular ratio category may influence another ratio in another category. And once you try to knit them together, you bring them together, you'll be able to see the picture much clearer and devise a solution that would help you cure that problem. In fact, or it is there. So inventory days, here basically what you're actually doing, you're checking how long does my inventory take before it is converted into cash. It's more of like a cash cycle. And it's inventory over cost of sales times 365. But if you have information in the exam which only shows credit purchases, please use credit purchase. Which shows purchases, just use purchases. So it shows how long a business holding its inventory. A higher number of days inventory might indicate holdings of obsolete or unsellable inventory. This is why any decrease in inventory is regarded as a cash inflow. And it's simple. If there's a decrease in inventory, it means that you could be selling those products, whether it's cash or credit. Eventually the cash will come in. So it's ideally cash inflow. But as your receivables increase, it's a cash outflow. So it will cancel out. That's a very intelligent way of understanding what is an inflow or an outflow. Trade receivables, here now you're also looking at how long does it take for those that owe me to eventually pay me. And this is now receivables, trade receivables divided by revenue, because your trade receivables are generated from your revenues. Or revenues, when you're selling, you will be creating receivables along the way, as long as you're not selling cash. As long as you're selling on cash. Trade payables, obviously be trade payables divided by credit purchases. Unfortunately, in the exam or sometimes when they're analyzing the financial statement, they might not be a discrete statement that actually looks at purchases, which ones are credit and whatever. And this is why it has been agreed that we use cost of sales, and the differences are quite minimal. Trust me. So any decrease in trade payables, it means that the company could actually be paying the suppliers of their services, and that is an outflow. But an increase in trade payables is an intelligent way of holding on to this money. Whatever you are selling, you sell. But you buy, you take a bit of some time. So it's a cash inflow. Solvency, gearing, risk. You have net debt over equity. I already explained on this. An increase in the gearing ratio indicates that either borrowings are increasing faster than equity or equity is falling more quickly than borrowings. And why equity will be falling? It could be that you have started in the recent past, you have been recording losses from the income statement. They go and sit under equity, so that they reduce your equity or increases it. You will need to understand the business equation. The business equation is assets equals liabilities plus equity plus profit less drawings. From the less drawings, basically, where you as the owners of company are drawing, we're making withdrawals. But that's the business equation, and that is what balances the balance sheet. Once you know that, then you have no problem. So an increase in the gearing ratio, I've said, or equity is falling more quickly than borrowings. In extreme cases, borrowings may be increasing while equity is falling. Then it actually now shows, you don't stop there. Just this is not a wrong thing. You combine with this, with your cash inflows. Do you have enough cash inflows? Is your business generating enough cash inflows to pay this debt? You look at interest cover. Apparently, sometimes these SCS, SIMA, whatever accounting, they don't look at the debt service cover ratio, but that is important. This is just a simple ratio on interest cover. Let's say with the operating profit over interest payable, how many times is your operating profit able to pay your interest? But you can go further and look at how many times would you So on interest cover, sorry, I'm getting distracted. So on interest cover, you're just looking at how many times you'd actually be able to pay from your operating profit.
Hello.